All right, how's it going, friends and family? My name is Amos, and welcome to another earnings week. Essentially, what you see on your screen right now is last week's companies that reported their earnings. We're going to be circling back on how things went. And between you and me, it's one of my more favorite videos to make because it's basically what I do every Sunday. I like to be informed of which businesses are reporting that week. That way, I might be able to pull the trigger when the stock market reacts emotionally and punishes them like 10-15% on that day. Because usually, if it's a high quality company, they rebound the next day. It's a really good opportunity for me to pick up shares of a company that I've been eyeballing for a really long time. But it's also an opportunity to be informed and stay up to date on current holdings. By the way, earnings is basically what a publicly traded company does every 90 days or 3 months. They tell you the progress of their financials and operations, but they also give you insights and guidance for the future. So if that sounds good with you, let's go ahead and get into it. So let's do a quick recap of what happened last week. So as you can see on your screen right now, on Wednesday, we had McDonald's report their earnings, but on Friday, we also had Wendy's. And they're both in the burger fast food space, right? Polar opposite results. I'm not going to lie to you. Like I said last week, I was thinking about jumping into Wendy's and then jumping out after a quick profit, but couldn't do it. It was just way too much risk. I just didn't want to do it. But I guess we should start off with Wendy's first, their earnings. They're going to close even more U.S. stores. So that was not on my bingo card because I already knew they were closing a whole bunch of stores, but they're making the executive decision to close even more that are not good for the bottom line. While McDonald's, on the other hand, they're ramping up. They're crushing it right now. Their value menu has been super popular with the American consumers because for the longest time, the growth, same-store sales growth, it's kind of stagnant, but now it's jumping back up, whereas Wendy's, it's declining. And I think when you think about McDonald's versus Wendy's, I know it's a very specific niche, but I think it's an easy lesson in going with the best in class versus the underdog, right? So like any industry you think about, right? Oil and gas, when you think about the industrials, manufacturing, whatever it is, there's always a guy or a company or business that's top of the food chain of the totem pole. So my whole thing is like, why entertain the ones that are at the bottom, the ones that are below average, the ones that are unprofitable? You know what I'm saying? And I think, even after Wendy's reported such a horrific earnings, they didn't really go on a sell-off. They pretty much traded flat, which tells me that the market already priced it in. The ones that were punishing them already punished them before their earnings. So they're pretty much like $7, but I still don't want to go near them. And by the way, the reason why I paid attention to McDonald's and Wendy's is because I'm actually invested into McDonald's. And when I say invested, I literally have like 1, maybe 2 shares. And I got to say this, at its current valuation, I do not think it's a good deal. Yes, I think it's a good beginner stock. Yes, I think it's a really good buy and hold stock, but at its current valuation, not necessarily a good bargain. And then also on Wednesday, one of my core holdings on the public portfolio, Cisco, they reported. And they got absolutely murdered. It was something like 10-11% drop the next day. I remember watching it, and I was like, dude, that is absolutely absurd. You would think they committed some kind of heinous crime or their CEO said something racist, but it's because their margins are going to be decreased ever so slightly because the cost of memory is going up. And I was laughing. I was like, that's it? So you're punishing Cisco that freaking hard? And for me, I mean, what do I plan on doing? I don't care. I'm not going to sell just because of that, right? Their core business model and their investing thesis, it's still intact. They're benefiting from the data center boom because they're supporting the physical AI infrastructure with their, I think it's called the Silicon One G300, something like that. It's their chips and their Ethernet switches and also their liquid cooled systems. I'm bullish on Cisco. So I'm just going to continue to hold on to them. I don't think they're the best of the best, but I definitely think it's a dividend compounder with cheese. And then if we zoom back, I think on Tuesday, S&P Global also reported their earnings. That's a company that I'm closely monitoring. I've been monitoring them since 2019. I've never pulled a trigger, and I thought it looked pretty good, right? However, their guidance going forward, it wasn't as perfect as Wall Street expected. And that's an issue when you're interacting with a stock that has a 35 or 55 PE ratio. When it's above that magic number of around a 25, 26, you're essentially priced for perfection. If anything goes wrong, if there's any sort of setback or disappointment, dude, the markets punish you so freaking hard. And that's why I don't blame value investors that only try to buy stocks that have a PE ratio of like a 10. And they're also happy with the fact that you're only going to get a small CAGR when you buy into something with a PE ratio of a 10. Because usually when you buy into something with a PE of like like Palantir in this case of 196, the CAGR for that bad boy is going to be much higher. However, on the downside, you could also lose a lot of your money. Whereas with value investing, the beta, it doesn't really swing too much up or down. So it really depends on risk tolerance. And then one more thing. What was I going to say? Lyft. Also on Tuesday, reported their earnings. And dude, I'm going to be honest with you. I think it's the beginning of the end for them. I mean, the earnings wasn't terrible, but their numbers confirm that across the board, Uber's eating their lunch. Because prior to Lyft, I think a week ago, Uber reported their earnings and they're crushing it across the board in their numbers. However, even though the volume has increased, their take rate, how much they're getting per transaction or ride, it's going down. But it speaks volumes that more and more customers are gravitating towards Uber rather than Lyft. So kind of an interesting development on that end. Okay, so now that we recapped last week, let's go ahead and turn our eyes to this week and beyond, because there's a lot. But before we get into it, can I just vent to you guys real quick? So every so often, maybe every 48 hours, I usually do some benchmarking, some market research on YouTube, take a look at some of the competitors, what they're doing. And between you and me, dude, I'm starting to get a little concerned. I'm starting to get worried about the amount of AI slop that's just plaguing the platform. Like, I tried searching up some of my more recent videos to see if it's going to be number 1, number 2, and number 3 on the search results. Come to find out, the ones that are number 1, number 2, number 3, it's usually videos that have AI animation, AI scripts, AI voiceovers, AI from start to finish. The entire product itself is AI. And what boggles my mind is that people are eating it up, right? You look at the comment section, they're loving it. Tammy from West Virginia, she's like, oh my gosh, I love this. It's got like thousands of thumbs up. I'm like, bro, what in the lactose intolerance is going on? Why are humans supporting AI slop? It's kind of frustrating to see because the algorithm loves it as well, right? That's what they're pushing. If that's what's number 1, number 2, number 3 on the search results, it's also going to be on the homepage of, I guess, potential people logging into YouTube. And then I guess videos like mine, it gets buried. It's all the way at the bottom or it doesn't even get recommended. And I'm seeing it in my analytics as well. Usually the impressions per video I upload, it hovers anywhere from like 20 to 30,000 impressions. And from that, I'll usually, convert at least 1,000 people to hop on over and give me a chance. But now it's dropped all the way down to like 8, maybe 5,000 impressions. I'm like, YouTube, what's going on, right? So while they're rewarding the behaviors of people that are taking advantage of, AI to create hundreds of videos a week, like real creators like me who actually sit down, think, write, put actual effort into their craft and wrestle with ideas, dude, we're getting smoked. My fear is that one day, I'm not saying today, I'm not saying tomorrow, maybe like a year, 5 years from now, I don't know. This trend is going to push out and force these small creators like me to just quit, right? Because when you're going up against a dude in India or Nigeria or whatever, and he's producing hundreds of videos utilizing AI, using AI voiceovers, AI scripts and everything, it's really hard to fight against that, right? Especially when the audience seems to like it. And that's what confuses me the most. Whenever I come across a video that's 100% AI, dude, I immediately click dislike and like the little button that says do not recommend this channel ever again, because I hate AI slop, right? And I'm fearing that one day the entire platform, or I guess for this industry like stock market content, it's going to be either just the big channels that are thriving or AI channels. The small creators like me, dude, we're going to be tapped out. But hopefully YouTube cracks down on that, because I listened to Spotify's earning, I think a week ago, and they're cracking down on it. Anybody that uploads music or whatever that's AI generated, they remove it right away. And I'm hoping YouTube can follow suit. Because, I utilize AI to help out with my thumbnails, but other than that, that's it, right? The people that use AI for everything, dude, I don't know, it frustrates me. But anyways, what do we got going on this week? Thank you for listening to me, because it's something that I've been really struggling with this week. For the past, 3 days, it's been really making me sad, right? Because the numbers are declining, and that's the reason why. But anyways, on Thursday, we've got Walmart reporting, and believe me when I say that every ear, every nipple on Wall Street's going to be very nervous. They're going to be paying attention and listening to what Walmart's going to say, because when you think about it, I know the ones that have been here for a while, I say this all the time, but it's true, right? Walmart's basically a proxy for the U.S. economy and the habits of the consumer spending. It shows us a lot, because when you think about it, they own about 22% of the grocery market share. And fun fact, Walmart's the biggest player in the grocery landscape. It's not Albertsons, it's not Kroger's. That kind of blows my mind, right? And did you know that bananas are the biggest selling item at Walmart? They sell about 1.5 billion pounds of bananas every year. And another fun fact while we're doing this, do you know who the world's biggest market share of toys? Hold on, I awkwardly worded that one. Do you know who sells the most toys per capita? It's not Hasbro, it's not Mattel, it's McDonald's, because of the Happy Meal. I know. These are some random ass facts that I just carry with me close to the chest. I just whip out whenever, but I think it's interesting, right? And Walmart, you know, the numbers that they execute and pull off, they're basically bigger than a small country's entire GDP. So when it comes to Walmart, I'm personally not invested into them. I used to be in 2019 all the way up to 2024 when they had that nice little spike. Sold out of them. But if you're invested into Walmart, I can't blame you. I think it's really high quality. It's a good defensive play. It's stable. And as of the last year and a half, it gives you a lot of growth in the share price as well. So yeah, I can't fault you. Me personally, I'm invested into their rival Amazon. I think their future looks a little more brighter, but I guess only time will tell. And then also on Tuesday, by the way, this is a high level. Soon enough, we're going to go into each day of the week in more depth. But Tuesday, we also have Medtronic reporting, which is one of the best medical device companies out there. And as you know, I'm really bullish on the medical equipment space. Anybody that operates in that space, I like. It's just a matter of not buying them when they're overvalued. And I think right now, almost every single medical device player is overvalued for the time being, which is unfortunate. But having said that, if Medtronic goes on a dip, this would be like my opportunity to jump in. And unless they say something that's catastrophic where their entire business model changes, then of course not, right? Then what else we have? I mean, there's a lot, right? There's Palo Alto, there's a home building right there, Toll Brothers, Kenvue, there's a lot. But we also have eBay right there on Wednesday after the markets close. They're reporting the earnings. Between you and me, dude, I know it's going to sound really crazy. I'm personally bullish on them. Because when you think about it, buying secondhand or items that are used, in like the past 5 to 10 years, I feel like it's lost the negative associations, right? I think in the past, I think people used to look down on you and be like, ew, are you wearing someone else's clothes? Seriously, that was the thing in 2003, 1998. But these days, thrifting like a Carhartt jacket or a Patagonia jacket from like 1980s or the 1970s, that's actually a huge flex. Like, that's actually really cool. And between you and me, it might sound disgusting, but for the past 5 years, gosh, I can't even believe I'm saying this publicly. For the past 5 years, I've gotten all of my jackets, pants, shirts, and almost everything else that I wear on a day-to-day basis at thrift stores. Or on Facebook groups that are like, buy nothing, when people give it away. I also participate. I gave away my entire MBA closet. So all of my work professional clothes, I gave away as well. So I'm not just taking, I'm also contributing. And yeah, I mean, that's been the game plan for 5 years, to save up money for the baby that was strapped to my chest this entire morning. Would I do it again? Absolutely, right? There's a lot of pieces in my closet that have a lot of character and a story behind it. I don't know, right? But I'm glad to be able to give it another chance rather than going into a landfill or, I don't know. Then again, I feel like that was a complete lie because I just looked at my closet and my wife did get me some soccer jerseys that are new. So not everything that I'm wearing is used, but yeah. My only concern though with eBay is they don't have an economic moat. When you think about it, right? I think what they're doing is a nice platform, but Facebook Marketplace, yeah, it's a real threat. And I feel like that's the trend across the board with the Mag 7. And what I mean by that is you might have a really spectacular product or business, but given enough time, you're going to get competition from the Mag 7. And I think that's one of the reasons why PayPal's suffering, because the option to pay with PayPal at a checkout for a lot of merchants, websites, and platforms has been removed, and now there's Google Pay, Apple Pay. Same thing with GitLab versus GitHub. Same with advertising. Same with everything. Pharmacy, robo-taxis. So at the end of the day, I mean, there's people that only invest into the Mag 7, and I used to not understand the logic, but now I get it. Because I think like 20 to 30 years from now, we'll start to associate Google, Microsoft, Amazon as our generation's Berkshire Hathaway. I feel like the folks that are in their 60s or 70s, I think Berkshire Hathaway as a true conglomerate, like that was a behemoth back in the day, but I feel like most of their lines of business, they got a railroad company, they've got insurance, they've got chocolate, they got running shoes, but they're not really doing anything groundbreaking. And I think it's like good business models of the past, but the ones that are really developing an economic moat in like the future, I guess, high growth territories, yeah, that's Amazon, that's Google, that's Microsoft. And that's why when I thought about Walmart versus Amazon, even though Amazon does not pay a dividend, I had to go with them. But anyways, I've said too much. This was supposed to be a high-level overview of the week before we get into each day. So let's do that now, okay? And to kick things off, Monday, which, by the way, happy 4-day weekend. Hopefully it was a good day for you to just relax, unwind, or get some stuff done around the house. By the way, I just uploaded a video talking about which software stocks are absolutely screwed because of vibe coding and all the other threats that appeared out of the blue. And I know for sure I ruffled up some feathers. There were people in the comments section that were very unhappy with the tier system that I developed. And listen, I'm not happy about it either, but it's the reality. It's an objective scale of who is, this type of business operation and what kind of economic moat they have, right? Tier 1 ranging all the way to tier 4. I don't make the rules, but it is what it is. And that's why in the tech space, not all of them are negative 70%, right? It's proportional in accordance to what tier you fall under. So I think it's kind of interesting for the most part as a general rule of nipple. If you have no idea what I'm talking about, watch the video that's uploaded right before this one. And I'm going to be uploading a part 2, elaborating my thoughts, because I'm not happy either that some of the best high quality companies are in tier 4. But it is what it is, right? Anyways, Monday, I genuinely don't think anything here is too noteworthy. Jump on over to Tuesday. We got 111 companies. Are you kidding me? Gosh. We got Medtronic. Obviously, there's Palo Alto. Dude, the whole cybersecurity space is getting battered right now. Yeah, see? And I cannot believe I procrastinated. I said that I was going to circle back and research the cybersecurity stocks, but I didn't have a chance because I was hammering out the tech landscape tier system. So I guess as soon as I'm done with this video, I'm going to research cybersecurity stocks. I feel like it could be in a good opportunity, unless, of course, Anthropic's going to vibe code security, defense, and firewall systems for all Fortune 500 companies going forward. And then obviously cybersecurity is not a good realm, but from my understanding, as we move more and more into a digital age, I feel like cybersecurity is really important, right? There's Republic Services. I'm invested pretty big into one of their competitors, Waste Connections. Actually, that's not true. Republic Services, their true rival and competitor is Waste Management. They're both fighting pound for pound for the biggest suburban and urban cities in the US, whereas Waste Connections is more like Dollar General. They service the areas that are neglected, like the rural areas, the national parks. You get my drift, right? So think of like Republic Services and Waste Management as like Walmart versus, I guess, Amazon. And then Waste Connections is more like Dollar General. So they have a huge economic moat because no one else is trying to fight them. But Republic Services, I think, is pretty solid as well. I think if this company goes on a dip for the earnings, given that they don't say something that's too crazy, that's another company that I would love to add to the dividend compounders with cheese portfolio, because it doesn't matter 2026 or 2020 or 2048. We're always going to pay for a service to make trash disappear for us. We don't want it to accumulate in our front yard. Till the end of time, trash disposal services and recycling and all of that, I'm bullish on. It's here today, here tomorrow. Obviously, it's not a sexy industry. They're not making robotics. They're not making drones or anything crazy, but it's definitely a stable defensive growth kind of a business, and that's definitely right up my territory. Other than that, we got Kenvue. Like, I've been trying to buy into this company for a while. Like, I don't think it's super high quality, but I think it's a really good bargain value play. I think, gosh, my memory is fuzzy because I calculated the math on when the ROI is worth it because they're getting acquired by Kimberly-Clark. You get, I think it was like 21, was it? Or 22? I have to watch my own video because I spent a crap ton of time researching about that. I think you get like $21 per share of Kenvue that you own in equivalence of Kimberly-Clark stock or something like that. And so as long as I buy into Kenvue under like, I think $19, it's like a good play. But they've only been bouncing up ever since the acquisition news came out. I almost pulled the trigger. I did. But it looks like that ship has sailed. And at this point, I'm like, whatever. If you're not in the know, Kenvue, is it Kenvue or Kenvue? Anyways, it used to be the consumer products line of Johnson & Johnson. They did a spinoff. Now they're their own standalone company. So Johnson & Johnson is more nimble. It's the pharmaceutical arm, and then the other side of the business is medical devices. It used to be a three-pronged approach. They got rid of the consumer side altogether because that was the one that was facing a lot of litigation for the baby powder, for the this and that. But then also their pharmaceutical arm for the opioid. Gosh, I cannot pronounce my words today. I've been living in Japan for way too long. The opioid crisis. And so no matter how you look at it, I guess J&J is just scandal-induced. There's Devon Energy, which I like this one, but I feel like out of the oil and gas field, this is not the one that I would want to buy into. The one that I want to buy into right now, I know it's going to sound weird, but it's Hess Midstream. And I'm not invested into them, but I definitely think it's a really good dividend income stock. So it's not one that I would buy necessarily for total return, but it's definitely one I want to buy to add to the second portfolio that I did not reveal on the channel yet. And it's all of my high yield vehicles like SCHD, BDCs, REITs. And I think Hess definitely belongs in that conversation. Toll Brothers, it'll tell us about, I guess, the economy in a general sense, because if there's more homes being built, which from my understanding of the real estate market, I was listening to a podcast the other day that went into depth about it, and it said that more and more homes that are being sold are sitting longer on the shelf rather than being sold overnight, rather than people coming in with a cash offer that's like 20% above the asking price. So that makes me really happy. Because for the longest time, it's been a seller's market, and now we're about to gravitate into a buyer's market, and I think that's going to be good. That's going to be good for a lot of my peers that are living in an apartment right now, and they're trying to buy a house, but they're waiting for the prices to come back down to earth, but also the mortgage rates to come back down. It'll be good. I think it's good when it's a seller's market. Sorry, buyer's market. I almost got myself canceled right there. I prefer a buyer's market. Now, obviously, if you're a homeowner, you disagree with me, and you're like, no, you're an idiot. I hope the valuation stays high. Like, I get it on that side of the spectrum, but there's people that are like trying to buy their first time home, or they just started a family, and they literally don't want to buy a house that's like $150,000 above the historical median price, but also the mortgage rates right now are ridiculous. So I try to think about it from the side that needs it more, right? Let's see. Yeah, I mean, I think this is a week of a lot of like random industrials and manufacturings and yeah, you know what? We're going to go ahead. I did not know that Lazy Boy was a publicly traded stock. Like I knew that SAC, you know, that really comfortable beanbag company. I knew that was publicly traded, but I didn't know Lazy Boy was publicly traded. Like this is a company that I would never, you would have to pay me to even consider investing into them. But surprisingly, their dividend profile is pretty juicy. 2.5% dividend yield, 10% dividend growth rate, sustainability of the dividend. Love to see that. But are they a dividend cutter? I feel like they're a dividend cutter. Let me see. 10 cents. Yeah, during the pandemic, they cut their dividend from 14 cents down to 7 cents, and then they resumed it back to what it was. But it's a dividend cutter. Even though it was only for 1 quarter, still a dividend cutter. But surprisingly, you know, the financials, there was an error. Okay, it looks like stockanalysis.com is having some kind of issues. Let me see if I can fix it real quick. It was just a matter of refreshing it. So as you can see, their dividend payout visually depicted. I think during the pandemic, a lot of companies prematurely cut their dividend. But I guess if we can pardon them for this, they're pretty legit. Wow, I did not think that a Lazy Boy furniture, couches, sofas was going to be... I didn't think I was going to look into this company, but it's definitely one that's piqued my interest. But what's the other one? I think it's called Lovesac, right? Lovesac. I remember when I was in middle school, right? We used to hang out at the mall. This was back in like, 1999, 2000, 2001, whatever. And we would always go inside of the Lovesac store and just sit on the beanbags. Now, obviously, the workers were pissed off, like, get out of here, scram, kids. They used to talk like that, believe it or not. And I always said, when I grow up, I want to buy a freaking love sack. And so I think during Christmas or Thanksgiving, I looked up the prices, and I was like, dude, are you freaking kidding me? It's like no less than $1,000 for a freaking beanbag. Like, yes, it's very comfortable, but my gosh. Wow. The past 5 years, negative 76%. So, surprisingly, though, their financials is not the worst in the world. They don't pay a dividend, but take a look at their cash flow situation. Free cash flow negative. So free cash flow negative, definitely not a company that I want to go near. So let's jump on back over to Tuesday. Now, actually, I think we conclude that Tuesday is kind of a wrap. Let's go to Wednesday. Anything crazy here? Yeah, there's analog devices. Let me just collapse this right there. Analog devices, booking. Wow, there's some heavy hitters right there, right off the bat. Hey, before we continue any further, so to keep you in the loop, I know half of you don't care, but the other half, you do care, right? So this is for the other half that are invested into my, I guess, story. So my wife, her maternity leave ended this week, right? So it's just me and the baby during the day, and my gosh, it's to say the least, something that usually takes me only a minute now takes me at least 10 minutes, right? Something that usually takes me 20 minutes now takes me up to an hour. So it's been an interesting transition, and I feel like my worldview and perspective on moms in general, like stay-at-home moms, dude, went through the roof. Like, if I ever find myself going back to corporate America and a mom that's been out of the workforce for like 10 years is trying to pivot back, and I interview her, if she's smart, she's qualified, and I feel like she can succeed in the company, dude, I'm going to hire her right off the bat. What moms do is so freaking hard, and I know from firsthand experience because I'm technically the mom, right? So up until this point, while she was still on maternity leave here in Japan, we were tag teaming it, right? Taking turns, doing separate tasks. I was doing a lot of the household stuff, grocery shopping. I do all the laundry, trash, dishes. I pretty much am the maid, right? And she pretty much does the breastfeeding. I know, it's a pretty funny dynamic. And since I work from home, now that she's back to work, it's my job Monday to Friday to take care of her from 6 a.m. to 5 p.m. And gosh, whether or not you're religious, dude, you guys please pray for me. It's, I think my plate's going to be pretty full, especially because she's 3.5 months old. Soon enough, she's going to start walking. I'm going to have to prevent her from putting weird objects into her mouth and, her running into a wall. Things are going to get really, the difficult setting right now, I would say it's like a 4, right, with a newborn. But I know once she starts walking and is able to throw things and whatnot, I feel like that difficulty setting is going to go up to a 9 out of 10. So, yeah. And something else that we're trying to do, or I guess we've been doing, is cloth diapering. And it's exactly what it sounds like. You reuse cotton diapers that they drop the nastiest, smelliest poop into. You wash it and you reuse it. And it's one way that we've been saving money. Because obviously, if you can't tell by my story, the wife is pretty much the one making the money. And I'm making enough to pay for like groceries or whatever. But it's really disgusting, right? Cloth diapering, I feel like, if I do the math, I feel like disposable diapers, it would be more convenient, but I do think we're saving a lot of money by doing the cloth route. Definitely not popular. I looked it up and it said something like less than 1% of American families do cloth diapering. 99% do disposable, and I don't blame you guys, because up until like she was 2 months old, her poop did not smell at all. Not an issue. But something happened as she turned 3 months old where her poop literally takes me out. Like, I have like that gagging reflex. I'm like, what in the, why is it so smelly? And mind you, she's not pooping solids yet, right? Apparently, right now it's just liquidy, but eventually it's going to turn solid and it's going to smell even worse. So that's what I'm saying. Please pray for me, guys. I'm a huge germaphobe and, kind of struggling with that. But anyways, on Wednesday, so I guess dad life is pretty interesting. So basically, you're finding out what your wife had to do, 10, 20, 30 years ago. I'm sure she felt the same thing that I'm feeling. Right? It's like, oh my goodness, it's a lot to handle. But as long as you can prioritize, multitask, and just systematically attack things one at a time, it's not too bad, but it is kind of difficult, not gonna lie. But anyways, Moody's, they're on my watch list. The Patreon family knows this is one that I'm trying to pull the trigger on. I definitely think with the S&P Global situation last week, it caused Moody's to sell off as well. However, at their current valuation, I do not think it's a good bargain. Because even though they're 420 and they used to be like, roughly 546, their forward trading multiple is still at 26. So to me, I don't think it's a good bargain. High quality, and I don't think that vibe coding, AI, or any of this nonsense narrative that's going around, it's not going to hurt Moody's business. Now, obviously, I could be wrong, but based on, I spent 7 days looking into the landscape of tech, right? And that's what I'm saying. If you haven't watched that video, watch it. It's pretty eye-opening, and I'm going to do a part 2 for it as well. Moody's is definitely insulated, and they're going to be just okay. I think... I'll just leave it at that because I want to save a lot of my thoughts for part 2. There's Occidental Petroleum, which I already know. Nobody would have invested into them if Warren Buffett didn't put them on the map. And it's one of the ones in the oil and gas field that I wouldn't want to invest into. But if you invest into them, bless your soul. I'm not bullish about them. If I had to do off the top of my head, a ranking system, I think best in class are the ones that are fully integrated, upstream, midstream, downstream, all in one and diversified in all of their lines of business. So I know this might be unpopular, but I would put Chevron as S tier and A+ as ExxonMobil, maybe even S-. And then from there, it gets a little hairy, it gets a little competitive. But as I said earlier with Hess Midstream, I definitely think they're a B+. I really, really like their business model. They're midstream. They're in the business of transporting the oil, so they get paid regardless of what the price of the barrel of oil is, right? I feel like the ones that I'm not really a fan of are just the ones that are primarily or just focused on upstream, because the price of oil, the demand, and the global supply, it really has huge effects that are out of their own control, and their margins could just get demolished overnight. Whereas with midstream, you're insulated from all of that. Downstream is kind of a gamble. It really depends on the economy because they're refining it into products that we use on a day-to-day basis, right? Like pavement, Vaseline, petroleum, and fuel for your car. And that kind of stuff is usually stable, but depending on the economy, it could tank. Whereas midstream, once again, should be stable. Because it doesn't matter if it's only 1 ounce of oil that's being moved in their pipes or 50,000 gallons of oil. They're going to get paid. And that's the flaw of their business model as well. Because even if there's a gold rush or waterfall of oil going through their pipes, they'll still get paid the same, depending on their contracts and the rates that they agreed upon. Anyways, let's see. American Water Works. This is a company that I have a few shares of, and I would love to buy some more, but at their current valuation, I wouldn't necessarily say yes. Last week, though, I almost did buy into them when they were roughly 121-ish, but I guess I was being a little too picky, because it doesn't matter, because it's the ship has sailed. For me, it was 119. 119 a share, I would have pulled the trigger. We got down to 121, but didn't happen. Yeah, I really like American Waterworks. Now, obviously, there's a lot of CapEx happening with the water space right now. If you're not in the know, I'll put you on. With the water utilities across the board, they're getting smacked hard because of a lot of the PFA filtering mandates that are happening. So they're spending billions of dollars in order to update and renovate their infrastructure so that forever plastics are filtered from our water system, which I agree, it's a good thing. But for the business, their margins are getting squeezed. So consequently, the markets are punishing them harshly. So that's why I'm like, could be the opportunity to pick up some more shares. And it didn't happen. But on the other hand, I have been buying up a software tech-related stock in lieu. So it's not like I just sat on the sidelines last week. And hey, there's V-Risk Analytics. This is a company that I shared on the Patreon. Another one of those that's going to be in the tier 2 bucket, super high quality, and they provide the data for the insurance companies. And I'll just leave it at that. Like, this is a really good one. This is one that I might pull the trigger on, so I'll be paying attention on Wednesday myself. Yeah, I mean, to see them at their 5-year low, essentially, the lowest price they've been since, well, I don't know, I guess they could fall even further, and I guess they will because the after hours are dropping even further. This is one I definitely want to pick up. I mean, if you're listening, okay, watch this, okay? Their dividend profile, a 15% dividend growth rate, and their payout ratio is 27%. Like, that is just absolutely bonkers. And if you take a look at their financials, it's like a slow and steady ship that just goes up and up. Well, ever since the pandemic. I think what happened in 2019 going to 2020, I think they sold off a line of their business or something like that. I got to do more research. Don't quote me on that. As a matter of fact, let me fact check myself. I think something happened to make that drop off happen. Okay, so it looks like during COVID, the pandemic, they gave a lot of relief to the policy holders and their the customers that they do business with. So they didn't charge them as much, but then they also had some like accounting stuff happening that year. But regardless, what you want to see is the trend, right? Up and to the right, and that's what we're seeing. And I don't think the top line is the most accurate way to look at how good they are, right? I think maybe the EPS could be a better situation, the profits per share, 56 cents in 2005 to $6.51 in trailing 12 months. And obviously their free cash flow is going to be magnificent. They're not making a lot of CapEx. So let's see. Yeah, the free cash flow is $1.1 billion. It's the highest it's ever been in the company's history. But all regards, it's a pretty good company. I want to buy into it. Like, I used to not give a rat's butthole about insurance, but I was listening to a Berkshire Hathaway annual meeting. Like, I listened to every single one of them up until like the 1970s or whatever. And they're usually like 3 to 5 hours long. And once I heard Charlie and Warren talk about the insurance space again and again and again, I had that light bulb moment go off in my tiny little brain. I was like, what? Well, if the greatest investor of all time, well, I guess that could be subjective because Peter Lynch is probably numerically one of the better ones. But anyways, if he really likes the insurance space, what am I missing? And then once I started looking into it, that's when I started buying into the insurance stocks. And now I see what Warren sees. And yeah, I'm pretty bullish on the insurance space because it doesn't matter about what the trends are. It doesn't matter about AI, or actually AI does matter because that's a tailwind for insurance companies because now they can improve their underwriting ability, but also automating a lot of the risk taking and the forecasting and everything else. But regardless, insurance is something that prints. Now, I think I got it wrong with investing into United Health because I think in the medical space, it's really controversial. But in terms of like car insurance, renter's insurance, homeowner's insurance, stuff like that, it really makes sense. Because if you get into a car accident, like that happened to me when I was stationed in El Paso, Texas, an undocumented guy rear-ended me because he was texting and driving. He didn't have car insurance, right? Because he was from over the border. And dude, that was a headache and a half. I called the cops and they couldn't do anything about it. And luckily, I have car insurance. So my car insurance covered it. Imagine if I didn't, right? So like insurance in certain aspects of life, it makes a ton of sense. Now, obviously, in the medical realm, it's polarizing. And for me, I kind of look at it as them giving the patient the funds and the monies to get the procedure, the surgery. But then there's also the dark side of claim denials, rejections, and stuff like that. Like, that makes my blood boil, obviously. But I think, like most things in life, unless you look at it with a bias or one-sided, then, you know, everything tends to be very extreme. But if you look at it from both sides of the argument, in the end, I do think like health insurance is a value add for society. I definitely don't like the current healthcare system. I know I say it time and time again. I feel like it needs reform. It's broken. I think it doesn't matter who you are. I think everyone can agree, like the healthcare system in the US, it's broken. It needs reform. Because like, I was stationed in Germany when I was in the Army, and I got to witness what good healthcare looks like for the local residents. And especially here in Japan and in South Korea, where everybody has insurance, right? It's not one of those things where you're going to go get a medical bankruptcy or medical debt because you need treatment for your cancer or whatever. Like, no, everyone's going to be covered. Everyone's going to be okay eventually. But I feel like there's also a line that you don't want to cross. Because when you go into the territory of, how do I want to word this? Of devaluing the doctors, the physicians, the medical specialists and everything, and you don't pay them the compensation that they deserve for their education and training, then you also end up with medical care that you kind of see in third world countries where everyone is insured. So it's like a fine balance, right? Like, I've heard praises about Canada's healthcare and medical system, but I've also heard complaints. Like, you got to wait 6 months to get seen, right? Because everyone and everybody is getting seen for the smallest issues. Whereas here in the US, like, if you have a medical emergency, you can pretty much be seen that day or at least that week. So it's like a balancing act. All that to say, I'm not a politician, but all I know is healthcare in the US needs reform. So having said that, I do think I made a mistake by investing into United Health. Now, obviously, not at the time when I put a lot of my money into them when they were $250, $260 a share. Like, had I sold out of them in October at $370 a share, would have been a great plan. But I did not do that, right? Still holding on. I think they're roughly like $2.99 a share. So I'm still in the green. But in hindsight, I kind of wish I would have sold out of them and rotated that into a more normal insurance company. But that's neither here or there, right? You live and you learn. Sometimes I get it right. Sometimes I get it wrong. Like, I sold out of Microsoft when they were closer to like $525, $530 a share. And then they dipped down to freaking, what is it, like $390 a share. So I got it right with Microsoft, but sometimes, I mean, how does that phrase go? You can't win it all, right? But one thing that I do get right is timing the bottom of when to buy. But like, man, when I sell, sometimes I wish I would have held on longer, and sometimes I wish I would have sold sooner. So it's one of those things. But green is green. I am still in the green with United Health, so I'm going to stop complaining because that's a blessing and a half right there. Oh, there's HF Sinclair. I actually made a deep dive video about them. And then Figma. This is a company that should be in part 2 of the tech landscape tier video. They were supposed to merge with Adobe. I think it was like a year ago. It fell through. And then Figma, I think everybody was hyping them up like, oh my gosh, I'm so glad that the deal fell through because they were $122 a share when they IPO'd. But look at that. Since they IPO'd at $122, now they're $22. They went down in valuation by $100. So I bet you those same people that were, high-fiving and screaming and being so happy that the deal fell through, I bet they still were a part of Adobe's portfolio. Because Adobe's also suffering, but if they were to join forces, I feel like their economic moat against the AI threat would have been a stronger defense, right? But standalone, now they have to fight against AI individually. And speaking of mergers and acquisitions, did y'all hear about Netflix and Warner Brothers? Apparently, they might not go with Netflix anymore. They might go with Paramount. the huge the scandal drama and debacle with that, I feel like that's one of the reasons why Netflix stock is getting crushed. And believe me when I say it's a company that I am paying attention to. But at its current valuation, can we pull them up? I know they're not reporting their earnings this week, but am I allowed to talk about them? Do you mind? I know you're sitting on the toilet, but do you mind? I mean, this is a company that I really like, right? I definitely think they have an economic moat in that the amount of subscribers that they have, right? When they decided to end the policy of password sharing, everybody thought that was going to be the end. Like, it's a wrap. Show's over. It was good while it lasted. But what happened instead? Their revenue increased by 15.8% year over year because when the people that were denied Netflix previously having access to it, they realized like, dang, I actually need Netflix. And they ended up becoming a paying customer. And then through that huge subscriber base, now whenever there is a price hike, the attrition rate, I feel like what's the renewal subscription rate for them? I wonder if this will have it. Would it be in the KPIs tab? That's the revenue, key performance indicators. I want to see if they have like a figure that shows the renewal rate. Like Costco's is like 89, 91%, depending on the quarter, which is pretty good. But I think Netflix is higher than that. But anyways, yeah, their massive subscriber base is such an economic moat because for a customer that only has the ability to sign up for one streaming service, do you think they're going to go with Hulu over Netflix? Like, I'm so sorry, right? It's always going to be Netflix. Disney Plus, I think an argument could be made. But when you have a subscriber base that's like, what is it, around 500 million people or something like that, that gives you a huge competitive advantage, right? Because when you have that many people, what's their, when you're getting $45.1 billion, that allows you to port back into the business by doing better production, by making best-in-class shows and programs. And apparently, I tuned into one of their earnings. They're making the pivot from making like high budget-oriented films and shows instead to doing reality TV. Because I'm not trying to say this is the right thing, but it's what they're doing to increase their margins. Because with reality TV, you don't really have to pay Brad Pitt $20 million, right? You basically pay someone like $200 off the street to document their life about how they're 700 pounds and they have trouble pooping because they have to get a toilet that's custom made for them. Stuff like that, right? And yeah, I just Googled it. Their churn rate is 2% every month. That's not bad at all. So Netflix is a super high quality stock, and same with like Spotify. And on the topic of Spotify, I'm not joking with you guys. I really like this type of content. Like, this is what I personally want to do, but I feel like this doesn't garner or attract an audience, right? That's why I have to make those random videos about like Amazon or something else that's trending, right? Otherwise, YouTube would never push my content. Spotify, the next move for this channel, like obviously when I get more time on my hands, like I'm going to be launching some merch. I've already developed, like I bought, now listen, I don't have that much money, but I bought a bunch of t-shirts to figure out which one is the best feeling fabric. So I already have the t-shirt down and I'm just working on the logo. So I'm going to be launching some shirts. And then maybe we'll do coffee mugs. I'm scared that it'll break during the transportation process and then there will be a lot of refunds given out and I'm gonna have to eat the cost. So I might not do the coffee mugs, but I think shirts and maybe stickers definitely gonna happen. But other than that, I'm also trying to, I guess, segue into podcasting. Because I have a lot of video ideas that can be done on a series or a weekly basis, right? I don't necessarily have to show my face. And Spotify is definitely best in class when it comes to like the podcasting space. Another company that I would love to own, but at its current valuation, it's too fat. Netflix, I get it, they're dipping. And then if you're invested into them, obviously you don't want to hear this, but I truly hope that it goes down a little bit more so that I can jump in. And I promise once I jump in, I'll make content after content talking about Netflix. But it's definitely one that I'm monitoring very closely. Okay? And anything else I mean, we're still in the mid-cap size companies, $8 billion. There's Wingstop. I had a buddy that put like his entire life savings into Wingstop during the pandemic. And I'm not going to lie to you. I was like, dude, you're crazy. And I hope it works out. You want to see what happens? So let's just do a max out. So he put it all in during that drop, right? When it was like about $60. Today it's $221. It goes to show you, like, obviously this is a very extreme example. You don't have to be right that many times. If you can get it right with at least one high quality compounder, that's enough to 3, 4, 5, 10x your net worth, right? Like the same can be said about the folks that went balls deep into Broadcom, balls deep into Palantir or Nvidia. Like in any sector or industry, if you could just figure out and find that one high quality compounder that's undervalued and you just put your money in and do nothing, the odds are pretty good. Now, obviously, the ROI could take 5 years, 10 years, 20 years. Obviously, 20 would be a bad ROI, but I guess we can drop it back down to 5 years. It's pretty good, right? And I feel like that can happen across the board. It can happen in oil and gas. It can happen in the restaurant space. It can happen in tech. The hard part is figuring out who is it going to be, right? Like, who's the next Palantir? So, who knows? But I don't know. I thought I would share that story with you. And I also had a buddy that went to the same MBA program with me. He was actually on my MBA team. He's a sweetheart. I love him. And I think in 2008, 2009, when he was in college, he put like his entire inheritance from his grandfather. It was like 10 grand into a REIT. Because during the recession, REITs got absolutely murdered. And then he did nothing. He bought it, did nothing, just sat on it, and he turned into a millionaire. I'm not exaggerating. Because I asked him when we were doing the MBA together, because I had my GI Bill helping to pay for the costs, but also living stipend. And for him, he had like 7 kids, because he's a Mormon. I was like, dude, how are you doing this? And he told me that his investment, gosh, I really wish I remember what the name of the REIT was. But he was living off the dividends. And I was like, wait, what? So it's like interactions like that, plus my education that got me into the stock market. Seeing like real people making a fat profit off of stocks or living off of dividends, it planted seeds in my head. I was like, wait, this stuff it can actually work. Because my exposure to the stock market in like 2005, 2010, 2012 has always been like day traders, people that are gambling, putting money into speculative stuff. But once I walked into the realm of like Warren Buffett, value investing, putting your money into quality companies when they're on the discount, and then obviously dividend investing, my entire worldview of stocks changed. And to be honest with you, I'm pretty happy about that because it's one of the reasons why I'm able to do YouTube full time, because based on my math, my portfolio eventually should be enough to retire on. And that episode I'm really excited to share with you guys because I think a lot of people think that you need a lot of money in order to retire when it comes to investing in stocks. But oh gosh, I don't want to give it away. Just bear with me. When I drop that episode, I'll share with you guys all of the data and numbers to show you that I did a lot of thinking, I did a lot of back testing, a lot of poking holes, but it should work out. And that's to not showboat or to brag or to discourage, but rather to encourage. So like regardless of how big or small your portfolio is, if you stay consistent, I'm telling you, like given enough time, you can also retire, right? As long as you don't make stupid decisions and start day trading or doing options or start YOLOing into speculation. If you do that, then obviously not going to happen. S&P 500 ETF or SCHD, call it a day. Yeah, it can truly happen. I think it takes like what? With the S&P 500, I think an average of like 6 or 7 years for your money to double. So if you have like a $200,000 portfolio, it can turn into $400,000 during a bull market, obviously. Like if it's like a catastrophic event that would push it back, timeline, right? Like maybe 8 years for the money to double, but I think it's like 6 to 7 years for your money to double. So think about it, right? Another 6 to 7 years, that 400 grand can turn into 800 grand. But having said that, let's see if we can, there's a timeshare company, Brookdale Senior Living, Vita Coco Company. I think coconut water is such a trend and a fad. Definitely wouldn't want to invest into it. I just, yeah. Here's another water utility company that I have a few shares of, American States. And I've been trying to buy into them last week as well, but I don't think they went down to the valuation that I wanted. So, obviously that ship has sailed as well. But obviously with the water utility stocks, what I have seen is there's a pretty predictable trend of these peaks and valleys. I'm trying to buy at the valley. And when I say valley, I mean the absolute rock bottom price, but it bounced off of it and I wasn't able to get my buy order triggered. But this is one that I want to increase my exposure. That way it can be a core holding in the public portfolio. There's Cheesecake Factory. It's one of my more, I guess, like in the restaurant landscape, I would put them as a C+. I think it's one of the better ones. But S tier is Texas Roadhouse, which I believe they report on Thursday. And I do own shares of Texas Roadhouse. I bought into them in 2020 during the pandemic crash. And I'm going to share with you guys some videos that I made in 2019, 2020, 2021. And you'll see that I'm exactly the same guy. Exact same risk tolerance. And Texas Roadhouse is a company that I spoke a lot about. And one of the videos that I'm going to upload eventually, I say eventually because, dude, with a newborn, there's so much on the back burner. The stocks that I personally bought into in 2019, 2020, and how they fared over the past 6 years. And almost every single one of them, 200, 300% in the green. Now, obviously, the timeline, it's a little manipulative because during the pandemic crash in March 2020, or April, I guess, everything went down 40, 50%. And so a lot of that CAGR is from that rebound, but I'm the same guy. And I guess you guys will see the consistency that I've never been interested in day trading, speculation, or hype stocks. Just not my thing. And I remember I made video after video warning against the idea of the meme stocks like Bed Bath & Beyond, AMC, GameStop. And yeah, it got me a lot of hate. But yeah. Anything else? Okay, let's go to Thursday because there's 144 companies to talk about. Now, obviously, there's Walmart. One thing that I want to point out is take a look at their trading multiple. It's a 46.8, and when you look at next year's EPS, the forward PE is a 46. So it doesn't matter how you look at it, their trading multiples of 46. Now, they're doing almost the exact same thing as Amazon without the data centers. Keep that in mind, okay? Now, if I pull up Amazon on your screen, their trading multiple, forward trading multiple, I mean, is 25. So you're telling me that Walmart is almost twice as expensive than Amazon. Yes, that's exactly it. So that's why, for me, it was a no-brainer. I sold out of Walmart, pivoted that money into Amazon. I feel like there's more value, more of the upside to Amazon. But yeah, Walmart, super high quality. As I said in the beginning of the video, if you're invested into them, I truly think Walmart's one of the very few buy and hold forevers. That's a good one. That's not financial advice. I personally used to be invested into them, and I understand their business model pretty well, and it's a good one. There's the Southern Company, a utility that I would love to own. But let me see. Yeah, it looks like they went on their little sell-off heading into the new year, and that was the opportunity. But it looks like that ship has sailed, so I don't think anything is going to change from their earnings. There's Comfort Systems USA. It's probably pound for pound the best HVAC stock out there. Yeah, currently trades for $1,300 a share. Like I was saying earlier, right? If you invest into the best of the best, regardless of sector or industry, so I feel like a lot of investors, you feel like the only way to make money is from AI. You feel like the only way to make money is from tech, but that's not true. HVAC. This company literally is in the business of AC, plumbing, refrigeration. Past 1 year, 235% into the green. That's just past 1 year. past 5 years, 2,000% into the green. So that's why when someone's invested into some random ass stock, I don't judge them. I look it up and then I try to see what they're seeing, because there's money to be made in every industry and sector. I think the only one that I feel a little bearish on is the airlines. I think to this day, I just don't see how they would compound your money when they struggle to run a very profitable operation with mitigation of setbacks. Dude, that was like such corporate lingo. Because when I think about the airlines, they're constantly replacing their fleet of planes. They're constantly dealing with the cost of fuel going up and down. How can you freaking predict or forecast your profitability when it's contingent upon how much fuel your planes consume? And then you're at the mercy of the oil supply or whatever the going rate is. There's a lot of variables that are out of their control, or there might be a pandemic, or there might be people boycotting the... Dude, I found out that a lot of people, not a lot, but I found out there's people that are canceling their flights to the US for the World Cup because of everything that's going down. And so like as an airline, yeah, you're going to take a hit on that as well, right? Well, but I feel like that's so far in advance, they'll be able to get other people from Italy, France, Portugal to get on those to fill in the gap. But you see what I'm trying to say, right? Like a plane, it costs them the exact same amount of money if it flies full capacity or with like 5 passengers. If there's 95 empty seats and 100 seats, they're losing money. So like with the airlines, I feel like the reason why I don't want to invest into them is the unpredictability. Because like I like to invest into companies where it's like smooth and steady. Business as usual, reliable, consistency, where you can kind of get a good idea of what their revenue is going to look like. But I feel like with the ebbs and flows of the airline sector, yeah. Now, Copart is one that, has my interest, but I'm also kind of scared. I think they're in the business of like wholesale car auctions. Am I right? Yeah. So they're the ones that provide the cars to the various used car dealerships all around the country. And if you take a look at what's going on with them, dude, past 1 year, negative 36.5% into the red. This is a company right now, $37. They were previously $63 a matter of months ago. And gosh, I did some market research on the used car market back in October, but that's when my daughter was born, so my brain is so fuzzy. October for me is all a blur. I'm trying to remember what the heck happened. Was it like something to do with like tariffs, inventory issues, or something's going on with the used car market right now? And if I pull open CarMax, which is probably one of the biggest used car dealerships, they painted a picture that scared Wall Street because for the past 2 quarters, their revenue has declined. I guess Q2 of 2026 is negative 5%. Q3 of 2026 is negative 6%. So something's going on with the used car market. And across the board, they're all getting punished, right? CarMax is down 52% for the past 1 year. So obviously, like, it could be a good time to jump in. But yeah, Copart, gosh, I really wish they paid a dividend. So I did a quick Google search, and the reason why Copart's suffering really badly right now is that insurance companies are doing less write-offs for their customers in terms of making the title salvage. And so as a result, they're getting less cars flowing through their auctions. So that kind of makes sense. Now, I feel like what I just said is a temporary speed bump. Like, I feel like that's not something that's going to be consistent. And it looks like, based on their own timeline and history, it's something that they went through not too long ago in 2021 as well, but also during the pandemic sell-off. So this is a company that has its highs and lows. It's a very cyclical sensitivity. It seems to be baked in. So for me, I don't think, because I feel like right now, I'm not trying to sway anyone. I'm not trying to convince anyone to do anything. I'm just telling you what I'm doing, sharing with you my thought process. With the tech sector being down 30, 40, 50%, that's where my attention is at right now. So when you think about the future of society, tech is going to be more relevant than ever. And when I see high quality names on discount by 20, 30, 60, 70%, that's exactly, as a value investor, where I'm trying to put my money, right? So like Copart and some of these other stocks, it makes sense, but like the deal seems better with tech in the end. And I feel like my exposure to tech is really small. So I'm trying to elevate it. Because when you look at the QQQ, which is tech heavy, the heavy lifters in that, NVIDIA, Broadcom, Microsoft, Google, it's tech. And the fact that I don't really have that much tech and I'm still beating the market for the past 6 years, I think like that's crazy. Because most people that have a really good CAGR or total return, it's because of like one stock that ballooned. I don't have that. It's just across the board, I had a bunch of companies go 30% in the green and then I sold out of them, 50% in the green and then I sold out of them, stuff like that. I never had a stock go like 500% or 1,000%. I almost did, right? With Palantir, I sold out of them way too early and I always regret it. I wish I would have just held on. And I also sold out of NVIDIA a little too early. Same with AMD. But I digress. I feel like right now I just don't have that much exposure to the tech space, whereas in the past I did. I nibbled here and there, but for the most part, a lot of my gains were made from value stocks, which is really freaking funny to reflect and think about right now. It's like, again, what I said earlier, there's many different ways to make money in the market. And just to prove my point, if I pull up, I don't know, ExxonMobil, right? I said that they're like an A+, S-. If you take a look at their past 1 year performance, it's 38% into the green without baking in the dividends, right? So like there's a lot of people that dismiss oil and gas. I think you're naive. I don't think you understand how the world economy truly works. Oil is super important to move everything. Cargo ships, industrial trucks, machinery, jets, everything goes off of oil. And yeah, I don't want to offend people. Because I know there's a lot of folks that are bullish on solar panels and renewable stuff, and I think that's good for the planet and everything else. But oil and gas, as it stands, it should still be relevant for the next 20, 30 years. Now, obviously, when I turn into an old man, I think the landscape of oil is going to radically change. I think our dependence as a society, it's going to get drastically reduced. But for the time being, oil still prints cash, especially with the current party in power. They're rolling back all of the green initiatives. And now oil and gas is back on the menu, right? So like I didn't see that tailwind coming, right? I mean, I did. Believe it or not, I uploaded a video back in 2024. Stocks, sectors, and industries that are going to thrive under the current president. And I watched my own video the other day and I was laughing because every single one of them exploded in valuation. And I'm like, why didn't I listen to my own advice? Right? Kind of funny to think about now. And there's Texas Roadhouse. This is a company that I truly like. Now, let's take a look at what's going on with them. Yeah, past 1 year, 7% into the green. I feel like a lot of the restaurants got absolutely murked at the end of 2025 last year. They went on a sell-off beyond belief. I didn't sell. This is one of the first companies that I bought back in 2019, 2020, and I just continue to hold on because for the past 5 years, they're in the green by 109%. I think the only thing I regret is not buying more shares. And, to have my average cost 2x in 5 years, it's a pretty good story, right? And the dividend growth rate being 11.5%. There's a lot to like about Texas Roadhouse. Revenue growth rate is 14% year over year. If you're from America or if you're traveling to the US soon, I'm going to put you on. Go to a Texas Roadhouse. It's an experience. You'll quickly realize like the American lifestyle, but also how good our food can be. The reason why I invested into them was because their food, best in class, in my opinion, especially for their menu prices of about $15 to $16 per person, but also how popular it is, right? If you look them up, their reviews and ratings on Google and Yelp, it's thriving. Obviously, there's a vocal minority of people that complain a lot, like, oh, this place sucks. But that's the case with even McDonald's and Chipotle or Domino's. It doesn't mean their food is necessarily bad. It's just a lot more people leave reviews when they have something to complain about. I also invested heavily into Cracker Barrel back in 2019, and it was one of my best investments back in the day. And as you can see, right, they exploded in their valuation. No, I invested into them during the pandemic, 2020, and once they jumped up in valuation, I jumped ship. But it's really sad to see what has happened since I jumped ship back in 2021. They're down almost 80%. This is a company that I would never, ever go near as an investment ever again. I think I went on rants before. They truly lost their way. I think they don't understand what their game plan is, nor their target demographic. And their leadership, I have zero faith in. So I would rather invest into Wendy's than Cracker Barrel, to put it into perspective. Like for Cracker Barrel, the investing thesis was really simple at the time. They make southern, home-styled, like home-cooked, good Thanksgiving meal food. And I went there a handful of times. Like my wife and I, we used to go there every Wednesday, and I loved the food. And their financials looked good at the time, and they paid a special dividend every year. There was a lot to like about them. But then after the pandemic, in 2021, heading into 2022, everything changed for them. And everything went downhill. The taste of the food, the direction of the company, even their menu. They made a pivot at one point to become like vegan friendly and healthy. And it's like, bro, we're not going there to eat a salad. We're going to Cracker Barrel to eat a country fried steak. You hear me? With some mac and cheese with butter and cheese on top. So I don't know. I just have zero faith in that company. But yeah. If you're invested into Cracker Barrel, I don't understand you. Like, you have to put me on and help me understand, like, what's the thought process here. And then, is there anything else Thursday? I mean, there's a lot, but let's see. Alarm.com? What even is that? Federal Agricultural Mortgage. Hey, speaking of which, I read an article by the Wall Street Journal. It was published, I think, on Sunday or Saturday. It talked about how we're in this weird crisis where there's more farmers over the age of 75 than there are under the age of 35. So the article goes on to talk about how it's a family business for the most part, right? You're born and raised as a farmer. It's not like somebody from New York City wakes up one day and says, "Dad, I want to be a farmer." No. If you're born and raised in Nebraska, Oklahoma, or whatever, if your dad's a farmer, you end up being a farmer. But what has happened in the past 20 years is that more and more farmers, because it's a family business, they don't want their children to follow their footsteps. And so they encourage them to go to college instead or whatever. And they don't become farmers. So as a result, it's a declining workforce. And it's a huge crisis the article was talking about. So I had that light bulb moment in my head. It's like in the past 5 years, we saw a renaissance and a lot of kids, Gen Z going into the trades like HVAC, plumbing, electrical work instead of going to college. And I feel like we might see another huge comeback for farmers as well. Because, for the longest time, we were telling everyone, because, some people say college is a scam, but it's a scam that allows you to get paid more. So in the end, I don't think it's a scam unless you go to college to be an English major and you end up getting a customer service job for like 20 grand. Then it's kind of like a scam. But in my case, I guess it's the biggest scam, right? I went to a military academy for my undergrad, and then I got my MBA at a pretty darn good school, and I make YouTube videos, right, for $500 a month. So, no, I don't think it's a scam, because I think through my experience, my education, and the relationships that I fostered and the network that I developed, it's worth it. I would do it all over again. But having said that, I feel like a lot of people want to go into the exact same line of work. And what happens is it's like a saturated workforce, right? I think heading into 2020, 2021, I think the biggest driver of students was computer science. Everybody wanted to be a software developer, write lines of code, go work for Meta or for Microsoft. And now we're finding out we don't need them as much as we thought. And they're actually one of the biggest pool of unemployed kids. You graduate with a computer science degree, you're more likely to be unemployed, just like the English major now. Because we're finding out that AI can write the code better than you can, so we don't even need you. So all I'm trying to say is I think there's going to be a huge comeback of people deciding to become farmers. Now, hear me out. I think it's because not only is it a different lifestyle, but lands and homes in Oklahoma and Nebraska, dude, you can buy a 3-bed, 3-bath, like legit house with like 3 acres, and then obviously the farm attached next to it for like 200 grand. You can't do that in Los Angeles. You can't do that in Seattle. You can't do that in New York City. So I think the affordability of it is one aspect, but I also think this younger generation, they're so like, they remind me of like the 90s, because every trend and fad comes and goes in cycles, right? Like hairstyles, baggy jeans, skinny jeans, whatever. Just like the 70s, this new generation, from what I have seen, they're really like eco-friendly, planet-conscious, renewable, green, like, you know what I'm trying to say? And I feel like being a farmer is one way that they can help add like fresh greens to the tables that they want to eat at, instead of having everything be industrial farmed or whatever. So, hey, you heard it from me first. I think farming is going to make a huge comeback. I could be wrong. I personally would never want to be a farmer waking up at 4 a.m. to go squeeze some cow udders or to pick up chicken poop. Not my cup of tea, but I definitely think farming is a really cool career field, especially if you're one of those people that's like, I don't know what I want to do, but if you want to work with your hands, I feel like it's a fun job. I mean, I've never done it myself, so I wouldn't know, but yeah. And then Friday, let's see. Oh, wow, Alibaba is reporting. I've said it before and I'll say it again. I'm not interested in the Chinese stocks because of their government's involvement in every detail and everything else. It makes me uncomfortable, right? Like, how do we know the numbers that they're posting are actually the numbers that they're posting, right? And I'm not even trying to say that to be mean, but you know, accounting fraud has been the case for several publicly traded Chinese companies at a higher proportion than I feel like American companies, at least in the last like 10 years or so. So that's enough for me to hesitate. But if I had to pick, it would be Alibaba or Tencent. Definitely, you know, their version of the Mag 7. But I know there's a lot of bag holders when it comes to Alibaba, because during the pandemic, I think people were, you know, flooding into Chinese stocks, because I think Charlie Munger bought into Alibaba as well. And so if your cost basis is like 250, they're currently 150. They're slowly making their comeback, but yeah, the ROI just ain't it. And on the topic of Alibaba and China and everything, I read an article on the Wall Street Journal. By the way, I have a few places that I really like to read to stay up to date. Wall Street Journal is one. I also really like The Economist, and I also really like Morningstar. So those are my big 3. But anyways, it talked about how, or actually it highlighted how, and the game plan of how almost every S&P 500 company has started to pass along the tariffs to the consumers instead of just eating it, right? And the price of stuff is going to go up a lot more in 2026. So that's something to be thankful for here soon enough. And I was like, well, thank the good Lord I live in Japan, right? Because I'm like, geez, I can't imagine the cost of this or that going up even more, especially with the budget that I have, right? So it's like, oh, goodness. So I don't know. I think the tariff situation has been kind of an interesting textbook lesson in real life. Because I mean, I learned about it in my economics classes, but we never really went into the extreme examples of slapping 50% across the board or 100%, you know, to our trading partner, or like 20% here. And it's been interesting to see the ramifications, but yeah. On Friday, we have Constellation Energy. So I finally got the chance to do a lot of research into Vistra, Constellation, and then there was one more that's based in New Jersey. Basically, utilities that also have like a nuclear arm, because I think nuclear energy is pretty sustainable, renewable, and it's clean, as long as you know how to maintain it. At its current valuation, the conclusion that it reached, I'm not interested. But if for some reason they drop off the cliff after they report their earnings, I do want to jump in. I do feel very bullish about the trajectory of nuclear energy and the power consumption of data centers. It's just, I don't want to pay for them when their trading multiple is 30, 35, or 40, if that makes sense. Because at the end of the day, it's a regulated monopoly, right? I don't want to pay for a utility that has a PE ratio of a 40. Hopefully that's not too harsh. And then anything else on Friday? We have PPL, another utility. And then I think this is the one that does billboard ads. I could be wrong. Lamar? Let me see. Yeah, the largest outdoor advertising company in the North America. Yeah, so if you're bullish on advertisements on the highways, it's Lamar Advertising Company. And then this is one that I did a deep dive on, Portland General Electric, a while ago when I broke down every single utility stock, which, by the way, you can watch that video on the channel. Super high quality. I really like them. The reason why they went on a sell-off, I can pull them up, past 1 year. They went on this massive sell-off because they had to do a lot of renovations and updates to a lot of their infrastructure in Oregon to prevent wildfires as a preventative measure. And because of the CapEx, it was eating into their profitability and free cash flow, and the markets punished them harshly. I wanted to buy into them. Do you want to know what my buy order price was? It was $38. $38, and it would have been a part of my portfolio. But guess what happened? The lowest price that they reached was $39.55, and I never got a chance to buy into them. And that's what I mean by saying I'm really strict with my buy prices and being patient. I think there's people that get FOMO and then buy into a company at any willy-nilly price. I can't do that. I don't have that confidence. I only buy when it hits my buy price target. And yeah, it's burned me a lot in the past because I miss out on a lot of opportunities, but it's also saved my butt more times than I can count. And it usually works out. And that's why I have a huge watch list full of stocks. That way, it's like fishing, right? You can't rush it. If you're patient, given enough time, one of the companies that I've been eyeballing will go to the price that I'm trying to buy it, and then I pull the trigger and then I buy it right there and then. So it's kind of fun. And that's why I kind of understand those of you that go hunting or fishing or whatever. Fishing was probably one of my more favorite hobbies during the pandemic. When we were not allowed to hang out with one another, I went fishing almost every day after school during my MBA. But just like that, right? Being patient. Being patient is such an awesome virtue that serves you so well across the board in life. Like if you're stuck in traffic and you don't have the virtue of patience, you're going to get road rage. If you're dealing with something difficult in life and you just want it to hurry up and be over and you don't have patience, that situation is going to be 10 times worse than it is, right? So patience is something that I've been working on for the past, I want to say, because I had really bad depression from like 2020 to about like 2023. But then after that dark cloud was lifted from my head, obviously there's some bad days, but for the most part, I'm good now. I've been working on other virtues of how I can be a good dad, how I can be a good husband, and patience is one thing that I've been working on for so long that I feel like now I can say, like, honestly, I think I am a patient person now, so I'm pretty proud of that. But anyways, I'm sure if you made it to this point in the video, you already know YouTube's my full-time gig, right? I talk about it all the time. It's how I make a living. And of course, my wife's the real breadwinner of the household, and I'm grateful for that. But between you and me, sometimes, dude, I feel like quitting. And because there are days when I compare myself to others, especially my peers who are now almost lieutenant colonels in the military, my peers who are senior directors in corporate. I just feel like I'm not living up to my full potential when you think about it from a societal title or status perspective, right? I should be also a major, gearing up to pin on lieutenant colonel. I should also be preparing to interview for a vice president role or whatever. But I'm making YouTube videos and I'm making $500 a month. And sometimes it hits me and I'm like, dude, I feel so ashamed and I feel so embarrassed. Because I know I have the ability, the intellectual capacity to do what my peers are doing, right? But I'm choosing to do this. And, sometimes I want to give up. I'm like, dude, this is so hard. Like the financial aspect is so hard. But again, what I just talked about, patience. I don't want to just give up because my entire life, believe it or not, I've always been a quitter. I've always given up far too soon. Like as soon as I felt the first sign of resistance, setbacks, pain, I quit. I would jump ship. And it's a terrible, terrible habit, right? And for the first time in my life, I'm not quitting. I'm not giving up. And I'm actually really proud of myself in that regard. So even though I might not be a senior director, even though I might not be a lieutenant colonel, I feel like in that regard of like personal growth, I'm so proud. Because like that perseverance, that mental fortitude of staying consistent and sticking with something instead of just giving up, I feel like there's going to be a rainbow at the end of this road. Right? So I'm not going to give up. So that's the good news. And having said that, like if you could do me a solid and click like on this video, I would appreciate it so much. Because one thing that I noticed is with the competition, or I guess my peers on YouTube, they might get the same amount of views, but they get the double or triple amount of likes. And that's because I never say click like, right? So I thought maybe I should start saying it, because it makes a huge difference. It can make the difference of me making $5 or even $10 for the video if more people can see it. Because if there's more likes on the video, then YouTube recommends it more. If there's not enough likes, then YouTube takes that as a clue that the video is just not good. So if you could do me that solid favor, I would appreciate it. Now, having said that, I love you guys. Stay safe. Good luck in the stock market. And just please be careful with tech sell-off. Not all tech stocks are created the same, and they're not all of the same caliber and quality. I definitely think some of them are going to go belly up. So just please be careful and think twice, okay? And I'll talk to you guys really soon. Peace.